S&P futures are pinned at 7,570. Nasdaq futures are stuck right near 29,770. We are looking at a completely flat implied open for Tuesday, July 14, 2026, but honestly, this column is entirely artificial.
Yeah, it's a textbook pre-market liquidity trap.
Exactly. Because if you look at the overnight session, we just got handed a massive geopolitical catalyst. President Trump reinstated a shipping blockade in the Strait of Hormuz, and that immediately prompted fresh U.S. military strikes on Iran.
Right, and just to be clear, we are tracking this purely as a factual event affecting global supply chains. We don't take political sides here. But the immediate financial reality is that Brent crude oil instantly spiked over 4%. It's trading past $85 a barrel as we speak.
Which is hitting the tape at literally the absolute worst possible time. I mean, we've got the June CPI print dropping at 8:30 a.m. Eastern.
Yeah, with a median expectation of 3.8% year over year.
Right, and then Fed Chair Kevin Warsh is giving his congressional testimony at 10:00 a.m. So if the market was desperately hoping for this, cooling inflation narrative to justify a soft landing...
Oh, a 4% spike in global oil completely destroys that.
Right. Because energy bleeds into everything. Shipping, manufacturing, you know it.
It does. And that brings us directly to what institutional desks are calling the pain trade this morning. Because, retail traders have been conditioned for years to just blindly buy the dip, expecting the Fed to rush in with rate cuts. But the institutional reality is completely pivoting.
Wait, pivot in what direction? Because everyone on financial TV is still talking about cuts.
They are, but they aren't looking at the real flows. Fed Governor Christopher Waller is already out there warning that if core inflation stays sticky, a rate hike is actually back on the table.
A rate hike? Wow, okay.
Yeah.
That is a massive shift.
It's massive. As of this morning, traders are actively pricing in a 51% probability of a September rate hike.
51%. That's basically a coin toss for a hike, not a cut.
Exactly. And that fear is physically manifesting in the bond market right now. We are tracking a really vicious, double-barreled headwind for equities today, specifically targeting high-growth tech. The first barrel is the U.S. 10-year Treasury yield, which is spiking to an 8-week high of 4.63%.
Okay, let me pause you there, because I think a lot of people hear, bond yields are up and they just completely tune out. So let's use the luxury mortgage analogy.
Oh, yeah, that's a good way to look at it.
Right, so imagine a high multiple mega cap tech stock. It's essentially a very expensive asset, and its valuation is based on profits it promises to make years in the future.
Right.
If the cost of borrowing money today, which is that 10-year yield, suddenly spikes to 4.63%, the future value of that extremely expensive asset collapses instantly.
Yeah, institutional analysts call that discount rate destruction. When the baseline cost of money goes up, that premium you're willing to pay for speculative future earnings gets severely slashed. Valuation compression always hits those high multiple growth stocks first.
And what's the second barrel?
The U.S. dollar. The DXY is strengthening aggressively, consolidating right around 101.0 as international capital flees into American assets for safety.
But wait, isn't a strong dollar usually a good thing, like a sign of a robust economy? Why is that a headwind for, say, Apple or Microsoft?
It's all about currency repatriation. These mega cap giants pull massive chunks of their revenue from overseas, right? So imagine selling software in Europe for euros or devices in Asia for yen.
Okay.
If the dollar becomes significantly stronger, those foreign currencies buy fewer dollars when the company brings the cash back to the U.S. to report their earnings.
Oh, I see. It acts like a quiet tax. So they could sell the exact same number of iPhones in Paris, but their reported revenue in dollars actually shrinks.
Exactly. Just because the exchange rate moved against them, so they're getting hammered from both sides, shrinking future valuations from the bond yield and shrinking current revenues from the strong dollar.
Which perfectly explains this liquidity trap we're seeing in the pre-market volume. The tension is coiling the market incredibly tight. I mean, the VIX is creeping up to 17.10, but as we mentioned, the S&P and Nasdaq are just refusing to commit.
They're trapped.
Right. It's like a mountainside loaded with heavy snow. Nobody wants to make a sudden move. We're just waiting to see if this 8:30 a.m. CPI print melts it safely or if it's a loud crack that brings an avalanche down on our support levels.
And we have very specific lines in the sand today. For the S&P 500, the absolute floor is 7,517. Our briefing notes are screaming that if 7,517 snaps, we are looking at a massive technical flush down into the 7,440 to 7,460 zone.
A full flush. And what about the Nasdaq? Because if tech is the most sensitive to these bond yields, their support levels have to be critical.
Oh, they are. The Nasdaq has this historically robust support shelf sitting right at 29,700. It has been tested 31 times in recent sessions.
Wow, 31 times.
Yeah, so if we decisively lose 29,700 today, it triggers a nasty bearish breakdown. Next target drops to 29,470, and potentially we flush all the way down to a major liquidity magnet at 29,230.
So this is a totally binary outcome waiting on CPI and Warsh.
Completely binary. If CPI prints cool-like, below that 3.8% mark, this liquidity trap springs a massive bear trap squeeze. The shorts will be forced to aggressively buy to cover, and we'll see a huge wave of buying pressure.
Right, a classic gap and go to the upside. But if CPI surprises hot, showing that $85 oil is really driving inflation, or if Chair Warsh delivers a hawkish testimony,
then those 7,517 and 29,700 floors just evaporate. The algorithms will pull their bids and will drop hard-to-find liquidity.
so money clearly isn't just sitting still while all this plays out. Let's dive into the pre-market gappers and the sector rotation because the internals are telling a really interesting story today.
Yeah, under the surface of those flat index futures, capital is aggressively rotating. Defensively, money is flooding into the energy sector, tracked by the XLE.
Makes sense.
Yeah, with Brent over $85, institutions are using cash-generative energy majors to directly hedge against inflation. If oil is causing the inflation, you buy the companies selling the oil.
But they aren't totally abandoning tech, are they? Because the briefing flags some major high beta action in semiconductors.
Right, the SOXX is seeing a massive high beta rebound today. Semiconductors had a brutal 4.8% sector-wide sell-off on Monday from that Asian chip rout, but dip buyers are swarming the memory makers today. SK Hynix ADRs are up a massive 6.8% in the pre-market.
6.8% is a serious bounce. So let's look at three specific tickers driving these pre-market flows, because this really highlights the rotation out of consumer tech and into specialized industrial tech. Ticker number one, Apple, AAPL.
Yeah, they're taking a hit.
Right, they're sliding about 1.3% pre-market down to around $313.05. And this isn't just macro collateral damage, right? This is being driven by a pretty brutal downgrade from KeyBanc.
Yeah, KeyBanc downgraded them to underweight, a straight-up sell rating with a price target all the way down at $250.
$250. That is way below the street consensus. I mean, Wall Street has been pricing in like 8% iPhone growth for fiscal 2027. What is KeyBanc seeing that everyone else is missing?
They're arguing that the entire consumer upgrade model is fundamentally broken. U.S. wireless carriers are aggressively rolling back their device subsidies. You know that era where you'd get a massive discount on a $1,200 smartphone just for trading in an old phone?
Yeah, again, a carrier basically paid for half your phone.
Exactly. Well, that era is ending. The carriers spent billions building out 5G, and with interest rates staying higher for longer, financing those subsidies is crushing their margins. They just can't afford to subsidize upgrades anymore.
Which triggers a devastating chain reaction for Apple. If consumers have to actually pay $1,000 out of pocket, the upgrade cycle naturally
lengthens, exactly.
Yeah.
People will hold on to their phones for 4, maybe 5 years.
And that doesn't just hurt the hardware revenue. Slowing hardware sales directly drags down their high-margin services growth, right?
That's the real structural threat. If fewer people activate new iPhones, fewer people are getting funneled into free trials for Apple Music or Apple TV, or paying to upgrade their iCloud storage for their new 4K photo.
The whole ecosystem stalls out.
Yeah.
And if you connect this back to our luxury mortgage analogy, Apple is trading at a 35 times forward PE.
Yep.
You are paying $35 today for every $1 they might earn next year. So in a world where a risk-free 10-year treasury yields 4.63%, paying a 35x premium for a company with a shrinking consumer upgrade cycle is, well, kind of insane.
The math just breaks. Which is why you see capital aggressively hunting for guarantees elsewhere. And right now, the ultimate guarantee in this market is a government subsidy. That brings us to ticker 2, Tower Semiconductor. TSM.
This one is wild. TSM is ripping 18% higher in the pre-market, trading around $272.84.
Explosive move.
An 18% move before the bell even rings is just staggering for a semiconductor company. What is the catalyst here?
Tower Semi just announced a $3 billion capacity expansion in Japan. They are building a specialized facility for advanced silicon photonics and silicon germanium chips.
Okay, let's break that tech down really quickly so you can understand why this matters for the AI boom. Traditional chips use electrical signals traveling over copper wires to move data, right?
Right.
But in massive AI data centers, moving that much data over copper generates an insane amount of physical heat. And heat is the ultimate enemy of a data center.
Exactly. So Silicon Photonics uses literally lasers to move data instead, vastly faster speeds, a fraction of the heat. And the silicon germanium allows those chips to operate at incredibly high frequencies.
These are absolute physical bottlenecks for next-gen AI. You literally cannot build the data centers without them. But the tech isn't the only reason the stock is up 18%, is it?
No, it's how they're paying for it. Tower Semi's not footing this $3 billion bill alone. The Japanese government, specifically METI, the Ministry of Economy, Trade and Industry, is stepping in and directly subsidizing $1 billion of that expansion.
Wait, $1 billion? A foreign government is just handing a private tech company $1 billion in free capital.
Straight up free capital. And that completely shatters Wall Street's financial models for this company because they don't have to take on high interest debt or dilute shareholders to raise that billion. Their profit margins on this new facility just expand massively.
Yeah.
Tower Semi just upgraded their 2028 guidance to $3.6 billion in revenue and $1.2 billion in net profit. Benchmark immediately slapped a $335 street high price target on them this morning.
So capital is fleeing the consumer-dependent hardware of Apple and just pouring into this government-subsidized industrial tech.
Exactly.
Which leads us perfectly to our third ticker, the pure defensive macro play, SHEL, ticker SHEL. They're up 2.1% this morning, pushing to around $84, and they're crossing their crucial 200-day moving average.
SHEL is in a perfect storm right now. First, obviously, the overnight geopolitical shock. Brent crude over $85 instantly widens the profit margins on the oil they pull out of the ground. And that boosts the economics of their Q2 integrated gas production guidance, which they just revised upward to 610,000 to 650,000 barrels of oil equivalent per day.
But there's also a massive internal catalyst happening today, independent of oil prices, right?
Yeah.
Today, July 14th, is the D-Day vote for Shell's $16.4 billion acquisition of ARC Resources.
Yes. And this vote is the immediate hook for institutional flow. Because during the lead up to this acquisition, Shell suspended their stock buybacks for regulatory reasons. If this vote passes today, that suspension ends.
Right, and let's quickly outline why a buyback is so powerful for the stock price. When Shell reactivates this $3 billion share buyback, they are taking their cash, going into the open market, and physically buying their own shares from the public and then retiring them.
They cease to exist.
Right. So you systematically shrink the total supply of shares. If demand stays the same, but the supply shrinks by $3 billion, the remaining shares mathematically become more valuable. Your earnings per share goes up even if you don't pump a single extra barrel of oil.
And it creates a mechanical wave of forced buying. It's not a human trader guessing. Once that vote clears, algorithms are poised to reactivate that buyback program after the market closes. Wall Street consensus is already at $100.46, and Scotiabank has a high-end target of $122 based on this crude oil re-rating.
Okay, we have covered an immense amount of ground today. Let's synthesize this so you are completely dialed in before the bell rings. We are looking at a market trapped on a razor's edge. On one side, we have a geopolitical energy shock driving oil past $85, threatening a second wave of inflation.
Right.
On the other side, an incredibly tense Federal Reserve with a 51% chance of a September rate hike hanging over our heads.
And beneath those flat S&P and Nasdaq futures, the smart money is moving fast. They are rotating out of overvalued mega-cap tech like Apple, which is getting crushed by 4.63% bond yields and dying consumer upgrades.
And they're hiding in cash-generative energy like Shell and subsidized growth stories like Tower Semiconductor. So, I mean, this pre-market setup really exposes how dangerous it is for retail traders to just blindly buy the dip right now without understanding the macro headwinds.
It's incredibly dangerous. If you buy a high-growth tech stock today just because the chart looks a little cheaper, you are fighting a spiking 10-year treasury yield, you are fighting a strengthening U.S. dollar shrinking their overseas profits, and you are fighting an institutional pain trade bracing for a hawkish Fed.
So, as we wait for the implied open to become a reality, I know you had a final thought regarding that massive Tower Semiconductor news.
Yeah, I want you to really think about the structural shift. We just saw a tech stock rip 18% higher pre-market. Not because they invented a cool new consumer gadget, but because the Japanese government handed them $1 billion to secure AI supply chains.
It totally changes the valuation metric.
It really does. If global governments are now stepping in to subsidize multi-billion-dollar corporate chip factories to the tune of $1 billion a pop, are we entering a totally new era? Like an era where a tech company's market success is determined less by organic consumer demand and far more by global defense budgets, national security interests, and direct government backing.
It's a massive shift. From consumer metrics to geopolitical alliances, it's fascinating. But for now, we are all just staring at that mountainside loaded with snow. At 8:30 a.m. with the CPI print and 10:00 a.m. with Chairman Warsh, somebody's going to trigger the avalanche. Watch those 7,517 and 29,700 support levels closely. Keep your wrist tight today. Thanks for joining us on the Deep Dive.